Joining us on the phone right now is Allianz Chief Economic Advisor, Mohamed El-Erian. Mohamed, you sent me a note earlier today saying that you are watching very closely what's been happening at the policy level, and at this point you think the technicals are flashing red. Why don't you explain your thought process here?
Absolutely, Becky, and thank you for having me on.
Thanks for being here.
So the fundamentals went from flashing red to constant red over the weekend. We're having now a critical mass in terms of the economic sudden stop. On the policy side, we were going from flashing yellow to green on Friday, and we're now back to flashing red. Why? Because I think that there's a problem with both what the Fed did and what the Fed did not do. As a result of that, and you saw that very clearly in how the futures traded after the Fed announcement and during the media call by Chairman Powell, because of that, we are going to see enormous pressure on technicals. And I disagree with Steve, which I don't like doing. The equity market is actually telling us a lot. What's telling us is we're going to have a disorderly open, and what's going to happen is contagion. When people cannot sell what they want to sell, they sell whatever they can sell. So be careful. We are getting signal of market malfunction. Hopefully it can get sorted out. But I really see red lights across the board. And people should be really careful out there.
You know, Mohamed, we've had a guest earlier this morning, and I've heard it circulated in other places, too, the idea of closing the markets. In your opinion, that be a good idea or a bad idea? Generally, you want the markets to be able to flush this stuff out and to be able to react in real time.
Yeah, I wouldn't close the markets unless I absolutely have to. And I absolutely have to if, one, it's a health issue, or health of people there, or alternatively, it is because the market imperfections have become so deep. But if you close these markets, the reset is really complicated. So
your opinion and your advice would be you absolutely have to see this through, even though it's going to be a little messy.
Yeah, and my advice has been what I have said over and over again: do not waste your general policies at this point. Look, we've cut interest rates by 150 basis points. It's the active inertia. It doesn't help, and then you end up doing the same thing over. It's like the American tourist in Paris who says something in English, the French person doesn't understand, and the American tourist simply says it again in English but louder. It doesn't work. This is active inertia.
Wait a second. Do you think the Fed and the other central banks should not have done what they did overnight?
I don't think we should have cut rates. I think we should have been more laser focused on areas of market failures, used much better policies. We have a range of policies that they haven't deployed yet. I would have gone with the laser-like focus and then followed up with the more general interest rate cut when that can have an impact. You know, allowing people to refinance and have more cash in their pocket, allowing people to have cheaper loans, that's not going to change the way people behave. People are scared. People are uncertain.
Mohamed,
it's engaging.
Can we talk about that? And I've been literally emailing all morning and then on the phone all over the weekend with a number of CEOs, government officials, and big investors, all whom are, frankly, as concerned as you are about the duration and depths of this crisis. What may be bad news economically may be good news medically, which is to say social distancing may keep people and keep this virus from spreading or at least limiting it. But the damage may be real. And so the question is, when you start to look at industries that could get hurt if this gets extended out for any meaningful amount of time, what that means, how you look at this. We've been talking about this really, unlike 2008, as a Main Street crisis, not yet a Wall Street crisis. But if it becomes a meaningful Main Street crisis, it could also become a Wall Street crisis.
Yes, to all, Andrew. I mean, from the very beginning, was it the end of January or beginning of February? I warned you, this is different. Economic sudden stops are different. And the reason why they're different is because they destroy supply and demand at the same time. Then we had an inherent inconsistencies that you just mentioned. Health policy at this stage is about separation, isolation, social distancing. Our economy is wired for integration, interconnectiveness. So, of course, we're going to sacrifice the economy for the good of the health issues. Of course we are. That's what we will do.
So, Mohamed, then the question becomes, though, if you're an investor today looking at this situation, in large part, you're betting on the policy response. And so the question is, what is the right policy response? You keep talking about it, trying to have a targeted policy response, whether that's from the Fed or, frankly, I imagine from the Treasury Department. But the question is, what does that look like?
So I told you what it looks like. It has three elements. One is sequencing. Any crisis manager will tell you sequencing is critical. In the fog of war environment that you're operating, you have to sequence your policy. Be careful how much ammunition you use when. So phase one is, first and foremost, protecting the vulnerable segments of society, protecting the most crucial sectors, health in the economy, and ensuring the functioning of markets. Then phase two is you deploy the general policies, massive monetary stimulus, massive fiscal stimulus. Then the second element of crisis management is proper communications. Tell people you have a plan. Tell people what the first step, second step, third step is. And indicate that we will learn as we go along.
Where are we then, Mohamed, along that spectrum that you're talking about?
We've gotten the sequencing wrong. We have deployed the general policies when they will not have an impact, and therefore we have used valuable ammunition, Andrew, valuable ammunition. You know, I tweeted last night that I was both baffled and upset by what the Fed did.
Right.
Baffled because it's clear to me that it's not going to address the market failures, that they're going to have to rush with another set of policies that are much more targeted.
Mohamed, Stephen Mnuchin's talked about going to Congress this week for the ability to bail out companies, rules effectively that limited his ability to do that post-2008. What does that look like, and how, to the extent you can get ahead of it, even though we're behind it, how would you imagine that would work?
So first, I think it's important for the Treasury to realize that the line asking for bailouts is going to be very long. The airlines are a leading indicator, but what they're going through is what others are going to go through. Restaurants are going to go through the same thing. Cruise lines have already gone through the same thing. Industry after industry is going to go through the same thing. So you have to have a basic understanding of what your principles for bail-in is, not just who you bail out, but importantly, how you bail out. You don't want to protect everybody that's invested in companies. You've got to be very careful as to how you bail out. So before you go ask for authority, please have principles as to who you're going to bail out, why, and how.
All right, Mohamed, we are going to talk to you a little later this morning because that's kind of the stage we've reached. We need to check in with people routinely every hour. We'll check in with you before the opening bell. You can go back and monitor things and bring us an update with this, but we really appreciate your time today.
I will. Thank you, Becky.
Thanks.